In this video, I'm going to talk about inside bars, what they are, how often they appear. I'm going to share a free indicator that you can use for Tradingview, which is going to highlight them, ways you can use them, and possible entry techniques. Hi everyone, and welcome back to another simple daily practice drill that I think you can use to become a better trader. And this one's called the inside bar. So let's go and take a look. So many of my videos are concerned with breakouts. And I think part of understanding breakouts is also understanding the opposite, when price doesn't break out. And the best way to look at that is looking at inside bars. This is also my 100th video, so I'm really proud of myself for actually putting these together, and I'm really grateful to everyone for watching them. I read all your comments and thank you very much for the feedback. I've tried to put some of that feedback into the new videos. So firstly, what is an inside bar? An inside bar is a bar that doesn't break out above the high of a prior bar, and it doesn't break out below the low of a prior bar. Now, some traders will distinguish between what's called a strict definition and a more relaxed definition. A strict definition will mean that the high cannot be equal to the high of a prior bar, basically a micro double top, and the low cannot be equal to the low of a prior bar, basically a micro double bottom. In this video, you can use either. So an inside bar is also a triangle on a lower time frame. A triangle is an area where bears have not been stopped out, nor have bulls been stopped out, and price squeezes into the apex of that triangle. We call this breakout mode, and this is usually a time for price action traders to take a step back from the market so they can wait for the next move. Dr. Al Brooks spends a lot of time in the Brooks trading course talking about triangles and how you can use them as well. And one of his statistics that is very relevant for us is that 50% of the time the breakout of a triangle will fail and immediately reverse. And that's why understanding how an inside bar works means that you can increase the probability of your trades. You can see on my blog here, I've got a post for this indicator. I have a free indicator for Tradingview that you can download. There's the link to it on Tradingview. It's also got some background on some custom settings that you can apply when you're doing your own research. All the code is also open if you'd like to use it to develop another indicator. So how do traders use inside bars? There are 4 points I want to cover. The first is that an inside bar is used to count legs. The second point is inside bars have different ways to use depending on whether it's a trending or a trading range environment. The third way is an entry technique based on the breakout pullback concept. And the fourth is an entry technique based on the breakout follow through concept. The first way we can use it is leg counting. In an earlier video on leg counting, and I'll put a link in the description below, I talk about how traders use inside bars to count legs. The market moves in waves, and that means volatility expands and contracts, and that contraction is typically the end of that wave. Here I've got the indicator loaded. We can see the market pushed up to the moving average. We went down, pause, down, and then reversed. So this is a wedge pullback for a second leg up. So how many inside bars appear on a regular day? Well, it depends on whether the day is a trending day or a trading range day. And the presence of a lot of inside bars is a good indication that today might not trend. This can prevent you from buying too high or selling too low. On this day, there were 18 inside bars. That's about double what you'd expect, and lots of trading range price action. We typically expect about 15% of the bars to be inside bars. On this day, most of them occurred at the end. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, only 11. And the day had trending moves all day. This was a small pullback bull trend all day, and it had about 10. This bear day had a lot of inside bars, a lot of two-sided trading and very strong reversals, and it can be difficult to hold for a swing. But it makes sense to have a strategy for how to trade with inside bars, because 15 to 20% of them on the chart are going to be them. So now we've covered leg counting. Let's talk about inside bars in trends versus inside bars in trading ranges. Let's have a look at this day. You can see we opened in a bull channel. You can see we've got a gap up and a bull channel. We're breaking above a bear channel from the day before, so it's a breakout, and there's a number of breakout points. There are also open gaps through here. So the presence of inside bars in this area are more likely to suggest a trending move up on a higher time frame sideways, a small pullback, and then trend resumption. This is a very common pattern on ES. In a trading range, these are micro legs that are not necessarily tradable on this time frame. They're telling trend traders that no one wants to buy above anymore, and the buys are probably lower at the moving average or somewhere down the bottom of the last leg or two. For counter trend traders, they're telling you to get out of a position. Strong bear bar, bad follow through. Bear bar got follow through, and now consecutive inside bars. As the market resumes up, we can see that this leg is less climactic than the leg before. There are way more inside bars, but these inside bars are operating as pauses in the trend. Up, pause, up, and then final pause. So you can see there's a combination of leg counting in here, probably on a higher time frame. If I pull up a 15-minute chart, so I can see the 15-minute chart without even seeing the 15-minute chart. Here we've gone up, pause, up, pause, up. So there's 3 legs up in this one 15-minute leg. So the presence of these inside bars here does not mean I need to get out of my trade. It might be a reason to look at a higher time frame and decide that the breakout is now on a higher time frame as well, and I might be able to participate in a larger move. If you were able to hold through this, including getting long on the next day, you were rewarded with a much stronger breakout. Here is a gap down and a trading range session. The presence of an inside bar here says that no one wanted to buy above that bar. That's telling me at the moment we've got a 2-legged move down. This could also be a 2-legged move up, another move down. Inside bars create layers of support and resistance, and they're a warning sign that you might not want to hold long if you bought 10. Here, if you bought 10, say you bought the close of 10, you had an option to buy more at the low of 10, and then you were able to exit break even. So the inside bar was a way of telling you that perhaps buying high is not the best idea in this particular environment. If we look at the same chart here, imagine we bought here or here. What about when we get an inside bar? Now, some traders will look at the fact that the inside bar closed on its high. I think that's good. Other traders will draw a small box around it or scale out of this trade if it goes below. But if it continues to go above, even if I get out, I want to be able to participate, which means buying once it starts to go above that inside bar is also a good idea. So you can stay in the trade. So an inside bar here is traded a little bit like a trading range. You're waiting for it to leave the range and then participate in the breakout. So you can see inside bars are a little bit more complicated because they are a pause. Traders are waiting for new information. If you're already in a trade, for example, you're in a breakout trade and you wanted the market to immediately go in your direction, an inside bar is warning you that the rest of the market doesn't agree. If you are fading a breakout or taking a limit order, a fade with a limit order, and then you get an inside bar, it also meant you can take this as a good sign because the market has stopped breaking out. But for you, fading that breakout means that the inside bar has not done what you wanted to do, to break out in the opposite direction. So you can see both traders, whether they're going with the breakout or fading it, need more information. A trading range is also what we might call a weak reversal. If the market is incredibly bullish and then there is a bear inside bar or a bull inside bar, it's an attempt to reverse the trend, but it's not succeeding yet. So what some traders will do is use it as an entry technique to enter the trend. This is called fading a weak reversal. So now we've learned a lot about inside bars. Let's have a look at some of the entry techniques that you can use to provide you with a basis to do further research and add them to your trading strategy. We can see here the market is going higher. You can say 1, pause, 2, pause. Oh, is that leg 3? It might be leg 3, but it's also a strong breakout above prior resistance. Instead of taking any action on the inside bar, because this is a tight trading range, some traders will wait for the breakout to appear, wait for it to fail, and once that breakout fails, they'll then enter in the direction of that move. Other traders might even just more aggressively bet that it's going to fail down here and get a slightly more advantageous entry. What about here? We've been strongly trending all morning. The first 60-minute bar is a big bull bar closing on its high. Here is a deep pullback, and here's another inside bar. On a smaller time frame, this is another leg. That makes it a 2-legged pullback, and a lot of bulls will be looking to buy here. You can also see that an inside bar is a triangle, a tight trading range, a test target. We broke out of the top of it and we've come back to test it. So some traders will actually buy above that bar and other traders will wait for the follow through and then buy that bar. The markets come back to test this inside bar later. Traders that are looking for a two-legged pullback to buy in a bull trend wait for a signal bar. If you buy this bar, the next bar is an inside bar. So this is a warning that this trend has weakened to the point that even when a strong signal bar appears, you can see this bar got follow through, this bar also got follow through, this bar is not getting good follow through. This trend is starting to finish, and we might be in breakout mode waiting for a new trend. In more of a trading range environment, other traders will use them to do the exact opposite. If this is a trading range with overlapping bars, some traders are selling above the high. They're betting that the breakout is going to continue to fail. One way I like to use breakouts is I like to wait for the breakout away from an inside bar and then see if it comes back to test either the high or the low or the inside of that bar. In this session, we've got a strong breakout above this inside bar. This is a tight trading range. It's a test target at the moving average. We're probably going to come back. On this day, we came back really hard. Because I practiced this technique a lot, I instinctively bought the close of this bar, and I'm willing to scale in lower, betting that if there are so many traders willing to buy above it, there's going to be even more traders willing to buy below it. Now, if you're practicing this technique, you can also wait for a confirmation. The traders are buying above here, look to either enter around this bar or lower, betting that it's going to act like a magnet. So you can see the price keeps coming in to test this tight trading range. Now, if you take this technique and move it on to the other inside bars, you can see you had a number of opportunities to buy when it pulled back into the range. You could buy here, pulling back into the range. You can buy in here. Now you have another inside bar. You can buy in here. You can even use it in trading range days. Traders were fading above the inside bar here. They never got a chance to sell above it here. Traders also bought below, but they decided this price action is not very bullish. We're above all the moving averages. We're probably going to drift either down to them or sideways, and traders got out. You can also see the effect of traders fading these inside bars below. If you were buying these inside bars and scaling in lower, we came back to test your price. This price action continues the rest of the day. Here's an inside bar at this range. Traders were selling above it. Inside bars, traders buying below. Now you've got a number of different ways to look at inside bars and work out how to trade them. There's one final entry technique that I want to cover. This is called the follow-through bar of an inside bar. The inspiration for this actually came from my friend and co-presenter in the Brooks Price Action Trading Room, Tim Stout. He uses these bars to enter on the follow through. Now, I made an indicator that you can download in Tradingview for free, which can click on a setting so that you can research this concept as well. So a special thank you to him. I'll put a link to his website as well. So I've got the indicator switched on. You go to settings. Now, if I zoom in, you can now see these small arrows above the bars. If an inside bar is a pause and traders are waiting for more information, the next bar is information. Here's a bear inside bar and a follow through. Traders will often sell the close. Here is a bear inside bar and a follow through. Traders sold the close. You can see on this day, inside bar follow through, traders selling the close. Inside bar follow through, traders selling the close. Even traders who are selling these bars here, maybe they say they sold more on the pullback. Their stop was where the stop should be. All good scalping techniques. On this day, gap up in a bull bar. No one wants to buy above that bar yet. Now you've got consecutive bull bars, but it's an inside bar. Traders are waiting for more information. As soon as 3 closes, traders are now buying the close or 1 tick above the high. Then later you have a pause, another bull bar, traders buying the close or buying 1 tick above the high. I thought there would be less traders doing that this day. It's more buy the close bar, and you can see the small gap there in between those bars, which tell you that a lot of traders, as soon as they saw that bar, even after the inside bar, there was follow through, bought the close. Even with the reversal on this day, inside bar, now you've got follow through. At some point in here, if I'm a bull, I probably want to exit my position and look to buy lower or wait for breakout to get back in. So in this video, we talked about inside bars. We talked about what they are, how often they appear, how traders use them, and some entry techniques that you can use in your own trading, either to correct a trade that's not working out or find an entry before other traders see the signal bar. They're a very valuable technique because they appear in both trends and trading ranges. Because it's a pause in volatility, it also gives you more time to think about your actions. price moves quickly, and the presence of inside bars can be a good thing, particularly if you're a newer trader, because it's giving you a little bit of time to think. Thanks very much for watching. I hope you found that valuable. I'm pretty excited. That's the 100th video on my channel as well. So thanks very much. I'll see you in the next video. My name's Tim Fairweather from Zen Trading Tech.